So that's the situation in the rich world. What about in emerging markets? Of course, this is where the growth has been coming from. Since 2000, emerging markets have grown by 5.6% per year. That's almost 3 times the rate of developed economies. So clearly, the impetus for global economic growth has shifted from the rich world to emerging markets. Much of that has been in emerging markets in Asia, in China, in India, and in Southeast Asia, a region which has a combined population of almost 3.5 billion people alone, those 3 that I talked about. This has been the key driver of growth going forward. Now, emerging markets haven't been universally successful. Those emerging markets outside of Asia that are dependent upon oil exports or mining exports or just aren't very competitive, they've struggled tremendously in recent years, and we'll get to each of those going forward. The assumption has been, and it's been in place for a long time, that as the world globalized, that the poorer countries would close the wealth gap with the richer countries. That's been the assumption. A lot of economists talked about that at one point in some utopic future, the whole world will be relatively the same level of wealth. Well, that really hasn't happened. In Asia, it's happening. Look at those numbers for China, Indonesia, Thailand. We've seen significant declines in the gap between their wealth levels and the U.S. wealth level. You see there, the U.S. wealth level is 100. You see in 1980, 2000, and today the difference. In China, the wealth gap has closed tremendously. From China's per capita GDP in 1980, just at the start of their economic reforms, was only about 3% of the United States. It was one of the poorest countries on the planet. Today it's 30%. Still relatively poor, but a tremendous, tremendous change. But that hasn't been the case in other parts of the world. Look what's happened in Latin America over the last 40 years. Argentina in 1980 was half as rich as the United States. It was a relatively wealthy country. Today it's down to 30%. Brazil from 40% down to about 25%. So in Asia, we're seeing this wealth gap close, and it's continuing to close substantially. But outside of Asia, not really the case. And this is a big challenge going forward. The assumption has always been in these emerging markets that we will get richer, we will enjoy the fruits of our labors just as they do in the United States or in Europe or in Japan. But that's not happening. We've seen a lot of unrest over the last year. If you've been following the news, you've seen protests across the Middle East, you've seen them in South America. And this is one of the key drivers of that, just the unfulfilled promises of the last couple decades. So let's talk about China. We have a lot to talk about with China. The Chinese economy grew by an official rate of 6.1% last year. That's the lowest rate since 1990, which is, of course, the year after the Tiananmen Square incident. Now, as I've mentioned before, the Chinese numbers need to be taken with a few grains of salt. But nevertheless, for the Chinese government to admit that the economy slowed from 6.8 to 6.1% is an admission that it was a very difficult year last year for the Chinese economy. Exports only grew by, I think it's 0.3% in China last year, so basically no export growth. Of course, with the trade war with the United States, exports to the United States fell substantially. Retail spending, consumer spending in China is still growing, but it's not growing by the double digits that we saw in previous years. It's growing by between 7 and 8% right now. So the Chinese economy continues to transform into a more consumer-driven economy, but its growth is slowing. We forecast this year, this is pre-coronavirus forecast, so we forecast growth of 5.8% for 2020, and we'll talk about the coronavirus in a second, and in 2021, 5.5%. So the Chinese economy is continuing to slow. Now, this is a normal development for a country that has reached middle income status, that is no longer such a poor country. We forecast growth by the end of this decade in China probably to be at 4%, if not a little bit below. So this trend is going to continue going forward. This chart is a couple days old. The coronavirus outbreak now is, there are now more than 10,000 confirmed cases, and I believe it's 214 deaths. It's very hard to predict what's going to happen here. This is the Lunar New Year season in China, so it's a mass migration of people to their home villages and towns at the moment when they can do that. But this has the potential to be quite a major crisis. There are already more cases of the coronavirus than there were of SARS in 2003. The death rate is lower, fortunately. There were about 700 deaths from SARS in 2003. So far, I think the death rate is 213, 214 at the moment. But this has the potential to be a major crisis. Now, if you think about what happened to the Chinese economy in 2003, it lost about 3 percentage points of growth during the SARS crisis. But in 2003, the Chinese economy was growing much faster. It was relatively healthy at the time. Now the Chinese economy is growing slower. It has issues with the trade war. It has issues with rising debt levels. So this could have not just a major humanitarian impact, but it could also have a major economic impact. There are already some economists who are throwing numbers out like 2% growth this year, 3% growth this year. I think it's premature to say that. We just don't know where this is going. But if this virus continues to spread, and if the death rate starts to rise substantially, this could have a major impact on the Chinese economy. And if it gets outside of China's borders, we've only seen very small numbers at the moment outside of China's borders. But if it does, it could have a huge impact on the economy this year. It bears watching very closely. The other big issue in China, which has been superseded in recent weeks by the coronavirus, is the issue of Hong Kong. If you've been watching the news, you know that since June, on weekends in Hong Kong, and even sometimes during the week, 1 million people at a time are taking to the street. It initially was a protest against an extradition bill, which would have allowed Hong Kong citizens to be extradited to China to stand trial for certain types of crimes. It's turned into a major pro-democracy protest in Hong Kong. And this has a number of impacts. First of all, it's caused a recession in Hong Kong, which is one of the most important economic centers in Asia. But it also it's forcing Beijing to make a very difficult decision. It can go in and crack down on the protest and take a heavy hand on it, but it will destroy Hong Kong's economy in the process. It will damage Hong Kong's reputation as an economic center irreparably. Or it can sit back and do nothing and hope that these protests peter out, which may actually happen because of this coronavirus crisis, that may actually result in these protests dying out. But if it doesn't, then China runs the risk that these protests spread to the mainland. They start spreading to Chinese cities. And if that happens, then it's a very difficult situation for Beijing to deal with. So it's a lose-lose situation at the moment for China and how to deal with the crisis in Hong Kong. So China's slowing, but a lot of people assume India will pick up the pace and India will grow and everything will be fine. Well, the Indian economy is doing quite poorly at the moment. We estimate it grew by about 5.3% last year, which is a terrible rate of growth for India, which is accustomed to growth rates of 7 or 8%. It in fact slowed to about 4.5% in the middle part of last year. A number of factors are behind this. It has not received much foreign investment. The government has enacted some economic policies, whether it be taking 86% of the banknotes out of circulation or putting new restrictions on other parts of the industry, on other parts of the economy. This has all caused substantial slowdown in growth in India, which a lot of companies are banking on as being their number one growth market going forward. And that chart you see there just reinforces what I said about foreign investment. India receives almost per capita some of the lowest levels of foreign investment in the world. When you consider this is a country with 1.4 billion people living in it, so 4 times the population of the United States, and it's receiving so little foreign investment. That suggests that there's a lot of uncertainty about India. And this works both ways. There's uncertainty about India's ability to be a safe place to invest, but at the same time, the Indian government is putting a lot of hurdles in place. If you've tried to do business in India, you know it's quite challenging. In China, when you invest, you go to Beijing and you get the approval and it's done. You go to India and you get the approval from Delhi, the state will tell you, go away, we don't want your investment. It's really challenging at the moment to do business in India, and this is reflected in these numbers here. The other key pillar of the Asian emerging markets is Southeast Asia, which I've talked about quite a bit. 660 million people living in these countries. You have some extremely fast-growing economies, places like Vietnam, the Philippines, Indonesia, all growing at least 5%. Vietnam growing by almost 7% at the moment. The Philippines by a little more than 6%. So some very high-growth markets in this region. And it's receiving a lot of foreign investment, particularly in the manufacturing sector. As China becomes more expensive, as investors and businesses become concerned about trade barriers with China, a lot of investment is shifting south. Vietnam has been a significant recipient of this manufacturing investment. Indonesia is picking up the pace in recent amount of infrastructure investment going into these countries right now with the hope that that will attract even more manufacturing investment ahead. And so far it's been bearing fruit, at least for Indonesia, at least for Vietnam and Malaysia at the moment. So that's Asia. We're seeing a lot of growth coming out of the emerging markets in Asia. Even as they slow, they remain the key generators of growth. More than half of the world's additional economic output in 2020, barring a collapse because of the coronavirus in China, will come from Asia. And that's a trend that will continue for some time. So what about the rest of the world's emerging markets? One part of the world that's done pretty well recently is Central Europe. So that's Poland, the Czech Republic, Hungary, Slovenia, even Romania, those countries. They've done quite well. We've seen growth rates that are quite strong despite the fact the population is declining in those countries. And we've seen wealth levels rise. You really can't call some of those countries emerging markets anymore. It's very to call the Czech Republic an emerging market and to call Portugal or Greece a developed economy really isn't fair, because the Czech Republic quite simply is much wealthier than those countries now. And that's a trend we've seen across Central Europe in recent years. Now, East Europe is a different story. Russia has been mired in a big slump since the oil price fell in 2014. It's recorded growth of about 1% per year since then, very little. Russia likes to project itself on a global stage as a great power, but its economy is anything but at the moment. And the same holds true for most of Russia's neighbors. So you have Central Europe doing very well. You have East Europe, which has been struggling and continues to struggle. And that just reinforces what I said about the rising wealth levels. Now, Russia had a surge in per capita GDP when the oil prices were high, but in recent years, we've seen almost no growth in that. But instead, we've seen growth in Hungary, Poland, and a number of other countries, which become increasingly wealthy.